All right, hello again. This is Mike with the NetPicks Inner Circle. In this week's options trade of the week, we're going to take a look at IWM, which is the Russell 2000 ETF. Over the past 2 months, we have seen a pretty significant change in the overall market environment. We've seen volatility explode, we've seen the intraday ranges really expand, and as a result, there's a lot of uncertainty in this market. I hear from traders on a daily basis that are very nervous about being active in this type of an environment. When you have headline risk overnight out of China and now Syria, there's a lot of potential movement that can take place in the blink of an eye. So with the natural instinct to go to the sidelines, I want to walk you through today how you have a lot of opportunity to be active in a very conservative way. As an active options trader, this is the environment that I want to take advantage of. We thrive in periods of good volatility. So let's go ahead and take a look at how we can potentially play IWM here for the next couple of weeks. Let's start out by taking a look at a chart of IWM. Anytime that I look to place an options trade, I always start out with the chart because I want to determine, do I want to be bullish, bearish, or neutral? I'm not looking to take a look at this chart. I'm not looking for specific areas of support or resistance. I'm not looking to time this trade perfectly. I'm just trying to form an opinion on what I feel IWM is going to potentially do here going forward. So looking at this chart, you can see I have a variety of different indicators on the chart. In fact, we can actually take those off, and which I'll do right now just to clean it up for us. The reason I'm taking those indicators off, I want to focus strictly on price action. What I want to focus your attention on is going back to late January into early February. We saw the initial wave to the downside. Okay, this moves to the downside right here. We followed it up with a quick recovery right back up to the highs. Okay, that was into early March. And then here recently, we saw another wave to the downside followed by another recovery. So this is the big volatility that I just got done talking about. My outlook going forward for IWM, as well as the rest of the market, I am expecting this thing to roll back over to the downside here in the near future. If I want to take a bearish outlook, the first way that I could do that would be just to buy an outright put option. The problem with that approach is I have one way of making money. I need IWM to move to the downside immediately, otherwise the time decay is going to hurt me. I am not as convinced on the timing of this trade. My outlook is that we are either going to get neutral and consolidate here or roll over to the downside. So instead of buying a put, we're going to take a look at selling a call spread. So I'm not going to go into detail on the technicals of this chart because that's not the focus here of this trading. Okay, I'm looking to sell premium and get some time decay working in my favor, get the volatility working in my favor. That's the basis for this trade, not necessarily a specific technical pattern that I'm seeing on the chart. So let's jump over to the trade page and let's piece this together. Now, like I mentioned a few moments ago, I've talked to a lot of people that just don't know what to do in this market because it's so active. You blink and you miss out on 300-400 points on the Dow. Well, I'm going to walk you through a risk-defined trade here. Okay, we're going to know what our maximum risk is up front. We're going to know what our maximum profit potential is up front. It's a very safe trade. It's a way for us to stay active in a period of uncertainty. The worst position, in my opinion, that you can take right now is just to go completely into cash. I don't mind if you want to cut back on your risk, but if you go completely to the sidelines, you have zero opportunity to make money. As an active trader, I need to be active all the time. Okay, I can't be stuck on the sidelines sitting in 100% cash because then I have no ability to make a return on my capital. So let's go ahead and talk through this. I'm going to take a look at selling a call spread, and we're going to utilize the weekly options here. And I'm going to take a look at the April 27 weekly options. They have 14 days left to expiration. Okay, that's that 14 number in parentheses. I'm utilizing the weekly options here for a couple of different reasons. Number one, we have seen a lot of quick moves. If we go into next week, let's say we get some news to come out over the weekend, all of a sudden missiles are flying and war breaks out. I know I'm going to an extreme here, but let's say it happens. If I get a quick move to the downside, the short-term weekly options are going to move faster. Okay, that trade is going to potentially move in my favor faster. And this type of activity that we've seen in this market, the very short holding times that we've been seeing the last few weeks, I want to take advantage of the short-term options here. On top of that, the time decay is also very significant with the weekly options. With only 14 days left, every day that passes, there's going to be premium that's sucked out of those options. That's what I'm looking to take advantage of by selling a call spread here. So let's go ahead and take a look. I want to take a look at the 156 calls. Okay, I'm going to right click on the 156 calls, go to sell, and go to vertical. That's going to pop up an order down at the bottom, which I've already got loaded up for us. I'm selling the 156 call, and then I also want to buy the 157 call at the same time. By selling a spread, this is how we're able to define our risk. If all I did is sell the out of the money call, if I sell a naked call, it has unlimited risk, it ties up a lot of capital, and I don't feel comfortable with that type of a trade in this high volatility environment that we're in. I want to be in a risk-defined trade just in case I'm completely wrong on my outlook for IWM. I want to know what my max loss is right up front. So we're able to do that by selling the call spread. So this is a dollar-wide spread. This thing is currently trading for 37 cents, right between 37 and 38 cents. It keeps flipping back and forth here. So let's say we can get filled at 38 cents. Let's go ahead and click on confirm and send. If I click 38 cents up front, that 38 cents or $38 per spread is the most I can make on the trade, regardless of what happens on IWM. So at initial glance, you're looking at that probably saying, well, $38, is that even worth it? Well, look at what type of capital this is tying up. It's only going to tie up $62 of capital per spread. So you can put this thing on 10 times and you're talking about just over $600 of risk. Very manageable trade regardless of account size. You can put this on 1 time, 5 times, 10 times, 20 times. It's a very liquid product. You can increase or decrease your size as needed to really customize things to your specific account size. Now, if we get filled at 38 cents, it's going to put my break-even point at 156.38. That's calculated by taking my short call, the 156 call that I'm selling, we're adding in the 38 cents, and that gives me my break-even point at 156.38. I don't care if IWM moves higher, lower, or sideways here, as long as it stays below that break-even point, I make money. So that gives me 3 ways of making money. I also make money from time decay adding up and from volatility decreasing. So now all of a sudden, I have 5 different ways of making money on the trade. Compare that to just buying an outright put. If all I did is buy a put option to put on a bearish trade, I only make money if IWM moves to the downside. So I have 1 way of making money. Now, in fairness, the long put's going to have far more profit potential. So if this market completely falls out of bed next week, the long put is going to make more money. So it's a higher risk, higher reward type of scenario. Well, I'm okay with that as long as that matches up with your outlook. But for me, I'm not as certain on the timing of this trade. We might be a little early here. We may have to, wait out a little bit further rally into this afternoon or early next week. So by selling the call spread, it's still a bearish position. I give up my unlimited profit potential, but in return, I give myself 5 different ways of making money on the trade. So I'm really starting to increase my probability of success long term. So again, I'm risking $62 to make 38. Normally, we are in the risk 2 to make 1 scenario. I'm comfortable with that because, again, we have 5 different ways of making money on the trade. That's why I'm willing to accept the bad risk to reward ratio. If I take a look at the trade page, one of the columns that I have on this page is this column right here. This is the probability out of the money column. If I take a look at the 156 call that I'm looking to sell, remember our break-even point's right around 156.38, right? If I go up to the 156.5 call, it has right around a 68 to 69% chance of closing out of the money. So essentially on this trade, I've got between a 68 and 69% chance that we're going to make money on this trade. So it's really shaping up well for us. Gives us 5 different ways of making money on the trade. If you're a little uncertain on this volatile environment that we're in, remember, we're risking $62 of capital. That's the worst that can happen. If we're dead wrong and we get a big move higher on this type of a position, the most I can lose on this trade is the $62. So we're really positioned well with this type of a trade. This is what I'm looking to take advantage of right now because the volatility is high in the overall market. I mean, even after the rally that we've seen the last couple of days, the VIX is still above 17. That's showing that there's more risk premium in this market right now. As a result, the options are more expensive. So by taking advantage of that volatility and selling premium like this, it allows me to get a really good profile on the trade. That's what we're looking to take advantage of. So this is a neutral to slightly bearish position. What I want to have happen going into next week, if we can get a move to the downside, perfect. If we move sideways from here, I can work with that too. Even a slight move higher, I'm okay. The one move that hurts me on this position is if we get a big move to the upside from here. So we'll put this trade on today. We'll take a look at it going into next week. We'll continue to manage it accordingly. As always, if you have any questions at all, feel free to leave a comment here in the blog or send me an email directly. More than willing to connect and help out there. My email is mike@netpicks.com. Right, so bearish call spread here on IWM. We're selling the call spread. That's our trade of the week. We'll be back here next week to recap all of our open positions and give you guys an update on this IWM trade specifically. All right, so I'm going to go ahead and wrap this video up here. We'll be back next week for our next options trade of the week. We'll talk to you then.